You're on the job hunt, or maybe you've already landed yourself a fancy new job offer. Congrats, by the way. And now you're looking over the offer and there are 401ks and ISOs and other equity acronyms that you aren't sure what to do with. How should you interpret it all? Are some employee stock options better than other employee stock options? So many questions. Let's sort it out. And no way are we going to chat investment options without talking to my fellow nerd and investment writer here at NerdWallet, Andy Rosen. Today we'll chat with Andy to break down the new higher benefits package, what you should be looking for, and when you should be a little skeptical. Hey, I'm Nikita. Welcome back to the channel. Just a quick reminder, neither Andy nor I are financial advisors, and this is not personalized financial advice.
So Andy, obviously everybody knows the 401k as the OG in workplace retirement plans, but they're not all created equal. Where is a good place to start for candidates when they're looking to vet a good 401k from maybe a not so great 401k?
If you're pretty close to deciding who you want to work for, chances are if that company offers a 401k plan, they've already chosen a provider. So your options are going to be limited by the selection that company's previously made. There are some things to look at if you're comparing employers by their 401ks. One would be, what is the investment selection that these providers offer? What kinds of mutual funds, what kinds of funds are available there? And what do the managers charge? Over time, management fees can really add up. So you want to maybe look at that if you're really sensitive to these kinds of costs. Another thing to consider is whether they offer both a 401k plan and a Roth 401k plan. There's whole videos on this, but really briefly, 401k plan, you don't pay taxes on the money you put in when you put it in, and then when you withdraw it, if you're doing it the right way in retirement, then you pay taxes on the money then. With a Roth 401k, it's basically the opposite. You do pay taxes on the money you put in, and you don't pay taxes later if you're handling it correctly. So you might want to see if that's available. If a Roth is important to you, they're less common, but many providers do offer them. Overall, though, I would say that what you really want to look at alongside all this other stuff is what kind of match does this company offer? Are they going to contribute to your retirement? Whatever investment options, fees, and stuff you pay, your company, if they're matching your contributions, then that money can grow over time, and that's basically additional compensation. You may not be able to spend it right away, but it's the company giving you additional money, and that's something you really want to build into how you're calculating, what you're going to get paid.
Absolutely, don't turn down free money. So Andy, what about a 403b or a 457b? Are there any significant differences between those and a 401k?
Yeah, it sounds confusing, right? These are three different kinds
so many numbers, so many acronyms.
Yeah, so there are three different kinds of retirement plans. They're called deferred compensation plans. Essentially, you're putting aside some of your money to be used in retirement, and you get some tax break based on how you decide to do that. These plans are not going to look too different to consumers. A lot of it has to do with what kind of company is offering the plan. So 401k is probably the most common. We just talked about it. Essentially, that's going to be, for-profit companies, things like that. A 403b is more common with nonprofits, and a 457b you're more likely to see with a state or local government job.
Okay. And should employees be expecting some of those same perks like a company match and things like that from them?
I think those questions about whether there's a match, what kinds of offerings there are and what they cost are questions you want to ask no matter which plan your company offers.
Awesome. Well, let's talk about stock options because this can be a big opportunity for employees. You have your incentive stock options, ISOs, and then you have non-statutory options, NSOs. Can you kind of explain how these options work for employees?
Sure. I just want to say before we get into anything that you really want to look at the specifics of whatever program your company offers. There's a lot of ways to set these up, and you want to make sure you understand more about, exactly what you're signing on to and what you're agreeing to when you make one of these decisions. But speaking really broadly about, how these things work, the big picture, an ISO is probably going to give you a little bit better situation with taxes. If you have the option to select an ISO, essentially what you can get there is you'll basically, if you exercise your options and hold them for long enough, you're essentially going to get yourself the opportunity to just pay basically capital gains tax. So whatever you bought the stock at, whatever you sold it at, you pay tax on the profits depending on how long you held it. With an NSO, these are generally given not just to employees, but also to, outside service providers, contractors, things like that. So that can be a good benefit if you're kind of a contractor, but they don't have as preferential tax treatment. So, that's a distinction, but, it may not be that you have both available to you, but you should know what you're signing on to.
Absolutely. And do you have any tips for employees for deciding how or when or if they should exercise those options?
This is a really personal decision. It's going to depend on a ton of things, right? It's going to depend on your tax situation, your immediate financial needs. If you're taking this as compensation and you have the opportunity to sell it and you have to pay bills, that's going to play into your decision. Another thing to think about is just, what do you think about your company long term and what's your risk tolerance? I mean, when you're invested in your own company that you work for, you're heavily exposed to that company. Now, you can also play an impact in its success or failure. So, that's why they give stock options. They want to motivate people to make a company succeed. But, say your company doesn't do well, there are cutbacks, you've got personal financial insecurity because of that, and then your investments are going down as well. So, there's a lot of things to think about there. You may not want to hold them for a long time for that reason. On the other hand, think about it this way. If it goes up, say you have a stock option to buy at lower than the current market value. So you buy it and you could sell it right away for a profit. But you also could hold it for a long time. And if your company is wildly successful, you'll be really glad you held on to it.
Right.
No one knows the future. And, you have a unique view of kind of how your company is set up to succeed. Again, because you have a role to play in it.
Absolutely. It's the closest thing an employee could possibly get to a crystal ball is that you're on the inside.
Right. Of course, you want to make sure that you are only making decisions based on information that's already public.
Yeah. Well, let's talk RSAs and RSUs, because those are a little different from stock options in that you don't have to purchase once the vesting period is done. How exactly does an RSU work?
I think RSUs are actually some of the simplest to explain. Essentially, your company gives you a grant of a certain number of shares and you are able to receive it at some specified time in the future. So when you again, it all comes down to taxes, right? So when you exercise these shares, you're going to pay taxes based on the market value at the time that you receive them. And then if you hold on to them, the price changes, you're going to pay capital gains taxes based on, what happens with the price of the stock between when you receive it and when you sell it.
Well, in general, would you consider one benefit a little more appealing for a potential new employee than another?
I would keep in mind that you're unlikely to have all of these options unless you're weighing multiple offers from multiple companies. And if so, God bless you. That's great. But yeah, I mean, many companies don't offer each of these things. So if you're choosing from inside of a job, you may just have to live with whatever's available to you. If you are weighing, this company is offering NSOs, this company is offering RSUs, which one is better? It really, again, it's going to depend. It's going to depend on what you may really like the flexibility of the ISO, the tax flexibility. But say, you don't want to hold your stock as long as you would have to hold it to get that full tax benefit. Maybe an RSU would look better. So it really just depends on what you want to do and what your comfort level in, holding equity in your company is.
Absolutely. Such a personal decision. Are there any red flags that you can think of that a new hire should maybe keep an eye out for when they're reviewing these financial compensation offers?
I'd go back to what we talked about when we talked about retirement plans. If your company doesn't offer a match, that may be a reason to look elsewhere. You can really look at that as money the company is paying to you. You don't have access to it right away, but you do have the ability to invest it for your future. And if a company doesn't offer that, you can kind of knock that off of, your calculation for compensation.
Definitely. Do you think that stock options and retirement plans in general are something that could maybe be something that an employee would want to consider if maybe the salary wasn't where they wanted it to be, but these other financial benefits are really good? Could that potentially push it a little bit over the edge as something you should really, really consider heavily?
Look at it this way. you can't eat stock, and you certainly can't eat stock options that you can't even sell the stock. So, you're going to want to make sure that you can have the kind of quality of life that you're going to want and the kind of income that you need. Your company's stock that you don't have access to yet can't really do anything for you financially. So if you're not comfortable with, the ability to put food on the table, pay your bills, etc., the stock isn't going to do you much good. And one way to look at it is, think of it as a bonus, right? If you can live on what you're being paid, and in the meantime, you're adding value to your company, hopefully, and the company is doing well, and ultimately, when you do have the opportunity to sell those, that can really help your financial situation. That said, if you do have some flexibility, there are lots of stories of people who got into startups early and took a lot of equity compensation and certainly wound up with more money than they would have if they otherwise had, taken their salary in dollars. So, it is really a personal decision about how you believe in your company, how much risk and investment concentration you're comfortable with, and, just how long you can wait to actually have your compensation. It's not the same as money because you can spend money immediately.
Whew, I know that was a lot. How are you feeling? Remember, these additional benefits are a good thing. This is extra money on top of the salary and retirement contributions you're being offered. And just one last thing that I want to leave you with. Remember a few weeks ago when we were talking about salary negotiations? Benefits can sometimes be negotiated too, and that includes equity benefits. Whether you decide to or not is of course up to you. If you're really happy with the salary you were offered, maybe this conversation isn't worth it to you. If your salary didn't land where you wanted, maybe these additional financial benefits can make up some of the difference for you. Or maybe you just want to be sure you're getting compensated fairly. Don't be afraid to ask questions about the equity component before you accept the offer and terms. Be sure you understand the details like size, vesting schedule, how the company doles them out, and whether it's comparable to any industry norms. And then, if you choose to, negotiate as warranted. Good luck out there. If you want to dive deeper into employee equity options, pop on over to NerdWallet.com where we break it down even more. But before you go, be sure to hit that like button and subscribe to stay up to date on all sorts of future nerdy content. I'll see you next time. Bye.